Yesterday, we heard some big numbers thrown around so far this week. Plans for hundreds of billions of dollars of spending from big tech companies as part of a Stargate plan had markets excited yesterday. Does it change the underlying fundamentals for some of these businesses? We're going to talk about it with Melissa Otto joining us from Visible Alpha, S&P Global's head of TMT research. Melissa, good morning. Welcome back.
Good morning. Thanks for having me.
What do you think about all this Stargate stuff?
It's exciting. I mean, there's a lot going on in the space, and it really triangulates a lot of different aspects of technology. We've got infrastructure, we've got cloud, and then we've got like a whole application layer that's starting to creep in.
Tell me about that. Well, what do you mean by that, and how do you kind of track that application layer? I like that.
Yeah, I mean, I think what's really interesting is that we've seen a lot of innovation happening at the model level and also at the infrastructure data center level. But what we haven't really seen is a lot of innovation happening at the end user use case application layer. Now, there's a lot of things being experimented with, a lot of things happening, but in terms of like broad adoption and what's actually going to transform our lives and where you see applications becoming ubiquitous, we really haven't seen that yet. It's up for grabs, and an initiative like this does position the U.S. and also potentially some of our companies, in a way that could be very positive.
What are the range of outcomes right now you think that this brings that maybe changes the existing range of outcomes? Like, weren't these hyperscalers already spending tons and tons of money? Like, at what point does that rate of change get de minimis?
The rate of change, I think what needs to happen is that the compute and the efficiency of the compute needs to make the generative AI applications very efficient for enterprises and individuals to leverage. And so as the models continue to train and learn, they get better and better, and ultimately that compute power is going to help to drive that. And by transforming data centers from general computing to accelerated computing, we see a foundation layer across data centers that could really support generative AI.
Talking about where that's going to hit the hardest in terms of beneficiaries in your coverage right now, like who's the most rock solid, Melissa? Who would like extra money and spending but doesn't need it?
The whole space right now is a bit of a rising tide. Right now, and it's still fairly embryonic, in terms of where the trajectory of generative AI is going to shake out. There's general consensus that it's moving in that direction. We're seeing the groundwork laid. We're seeing a lot of initiatives. We're seeing creativity creep in, co-pilots emerging, all these different things that are helping to drive that innovation, but it's still up for grabs.
Okay. Thinking about I guess, underlying fundamentals, do the companies in this hyperscaler, in the big tech space, do they still meet high quality definitions of financials in your mind, Melissa?
Absolutely. Fundamentals are going to be critical for these companies, in terms of their free cash flow, in terms of how they invest, and also aligning with their shareholders in a way that justifies the level of CapEx that they're spending. I think shareholders are likely to be comfortable with the investment, provided that they feel the longer term return on that investment is going to come to fruition. And I think they would like to see incremental evidence of that. Normally we do see that in the earnings calls when companies demonstrate that with their numbers and then also articulate it with their stories.
Good stuff, like the perspective and a good reminder of the stability here, the rock upon which this market is built. Thanks, Melissa.
Thank you.
Let's go to George Tsilis. We've got some trades looking at Oracle, looking at Microsoft. George, you got a pretty bullish trade on Microsoft you're structuring. Take me through it.
Yeah, I mean, if you consider what's going on, obviously with the Stargate initiatives, OpenAI, and the relationship Microsoft has, there's a lot of compelling story behind this particular name, and of course the dominance that Microsoft has in the enterprise software space. But if you consider also the events next week, we've got earnings coming out, I believe, on the 29th for Microsoft. So we're going to trade around the earnings. We're going to structure a bullish trade and capitalize on high implied volatility in the options that expire next week. So what I'm going to do is I'm going to structure a long call diagonal spread. This is structured for a debit. I'm going to sell next week's expiry, 8 days to expiry, out of the money 460 calls, and I'm going to use the proceeds of those sold calls to purchase the February monthly in the money $435 calls. So we're essentially playing this as a bullish trade with capitalizing, like I said, on that high implied volatility. Now, altogether, you could structure this for about $13 a share or $1,300 a contract. So in essence, it's bullish. You just don't get to participate if the stock moves beyond the short strike by the end of next week at 460. Again, your break even is 448 if you do hold this entire position until expiry in the February contract, which again expires in of course 29 days. So you're essentially capped between now and the expiration for the January contract. But then again, if it doesn't, if you're not exercised on these options, you do get to participate in the total upside potential if it does continue higher for the February contract.
Okay, so you get the upside and then you get capped out, but that gives you some breathing room also to the downside too. I feel like we did a trade similar to this yesterday, George. We bought the in-the-money call, and I like that approach because it gives you, early on in the trade, like 1-to-1 almost for gains. Or rather, you start making money with each tick higher when you start with the in-the-money call.
Yep. Yeah, and so if you look at the probabilities around this kind of structure, I'm basically selling the expensive out of the money, near-term option, which has higher theta decay as well, time decay, and I'm buying the in the money, distant out option, which again already has more intrinsic value and actually has a higher probability of profits.
Okay. Higher probability of profits because you got the in the money and you're hedging it by selling the further out of the money call, which I think for a lot of these big tech trades seems like a good way to approach it right now. So I like that. You got a different one though for Oracle, George, after a pretty fresh pop yesterday. Different chart to deal with.
Yep. Yeah, so if you look at the chart, there's sort of a fair value gap that goes back to December, about a month and a week ago, so about 5 weeks ago. So that also corresponds to yesterday's low, which is right around the $180 mark, and it's trading around 185. And you can see that today they tried to, push it below that, but the buyers stepped in. So what I'm going to do in this case is I'm going to structure a neutral to bullish trade, and it's a very simple trade. I'm going to sell a cash secured put. I'm going to go out to February with 29 days to expiration, and I'm going to sell right around the 180 strike, and that's corresponding again to yesterday's low, today's almost level low. And again, you could harvest about $4 a share or $400 a contract. So in essence, it's a very simple trade. If it stays above 180, that $4 premium that you sell for or earn will erode to zero. That's the whole objective of the trade. If you do structure this trade, you have to consider also the risk. You would be assigned shares at 180 if the stock goes down below that level between expiration now and expiration. But at the same time, you can structure this trade if you are willing and able to take ownership at a lower price, but your break even is at 176.
Okay. All right. A little bit of a different approach, given the pop, basically betting that this thing's not going to reverse and crash, which is also, I think, a pretty good high probability approach to it.
Correct. And so if you look at the option premium as well, or the option delta, it's around a 35 delta, which does again imply about a 65% probability that the stock will expire out of the money, which again is what you want, and the out of the money would be above the 180 strike.
Okay. Just obviously monitor the trade and be aware, and I guess be ready to own some Oracle if it goes against you, which is not the worst thing. I mean, that's kind of the point of the trade too. You get into something that's been crushing it. GT, thank you very much. Appreciate the trades.